Hello, everybody. Welcome to Kansas City, Kansas Public Library main library in our program exposing the myth of retirement investments. Our presenter, Mr. Hartzler, will do the second part of this webinar. Mr. Hartzler, the screen is yours.
Thank you very much. I want to go briefly through the slides we covered last week, just to refresh your memory. Okay. We talked about the first myth being when you get to be retirement age, your planning horizon is short. That's not true. Your planning horizon goes on, and this illustrated how long you might live after you're retired. So that's the good news. The bad news is your money has to last then too. So then we talked about what Warren Buffett would say if he were giving this presentation, and we'll come back to this time and time again, but he's recommending for most people low-cost diversified index mutual funds. And so we talked about what he means by that and how it affects you. And then basic investment options, individual stocks, individual bonds, stock mutual funds or bond mutual funds, and what Warren is talking about here are stock mutual funds. And then we talked about the capital markets, how they've rewarded people. This graph shows how things have grown over time, about 10% rate of return per year for stocks. But this is really a bumpier ride than what it shows because of the scale over here. But over the long haul, things do go up. And then we talked about bull and bear markets. Point is, 3/4 of the time you have a bull market, stocks are going up. A quarter of the time you'll have a bear market, stocks are going down. Just have to ride out through those periods if you want to make returns. And we talked about the various returns. They're greater with stocks, but the volatility is higher, high highs, low lows. 1 year, when you out to 10 and 20 years, it smooths out very nicely. So if you're a long-term investor, that's what you get. We talked about the returns on various portfolios between all fixed or safe investments like government bonds and so forth to all equities. And you go from about 3 or 4 to, in this case, 11 over a period of time. Then when you look at the fluctuations in a 10-year period, it smooths out very nicely and you get the same kind of a return. So the point is that equities, nothing to be alarmed about if you're a long-term investor. Then we talked about risk, and this was interesting. We broke it down into business risk, systemic market risk, and inflation risk. The chance the business fails, well, the antidote is to diversify through mutual funds on a lot of companies. Systemic market risk, we talked about the chance the entire market takes a hit. Nothing you can do about it except limit the number of shares you sold. We talked about looking at dollars versus shares. Shares is what you can control, dollars not so much. And then the biggie, inflation risk. If you're a fixed income a retiree like I am today, that's what I worry about. And current inflation is definitely a risk. And the point here is that safe investments, T-bills, government bonds, things like that aren't really safe because the inflation will eat you alive. And then again, the antidote is to invest in stock mutual funds. We talked about 5 concepts. We covered 3 of them last time. The market's a bid and ask auction. It's brutal. We talked about the folly of trying to beat the market. Most people cannot. And then we'll get into a lot of time today talking about the reasons most investors don't get market returns. And we'll talk about the argument for extreme diversification and the perils of being out of the market today. So we talked about the bid and ask auction. You have to have a willing buyer that thinks the stock's future is bright. You have to have a willing seller that thinks the stock's future is dim. And the point is that given access to identical historical data, there's perfect disagreement on what's going to happen to any individual stock. But surprisingly, both must agree on a price or there's no deal, and there are a lot of deals made every day. Then we talked about the mutual fund options. There are actively managed funds and passively managed funds. Actively managed funds, we'll talk some more about those today. You have to pick which stocks to buy and when to sell. And the fees are 1 to 2% of the investment balance per year, typically. Passively managed funds, and this is what Warren Buffett is suggesting we invest in, and they just buy and hold a broad range of stocks that may mirror an index, and the fees are much, much less, a tenth of what they are, because there's just not you're not picking stocks. There's not that kind of work involved. And then the folly of trying to beat the market. It's not a one-on-one competition. It's you against the world. It's very brutal. You got to buy at the right time and price and sell at the right time and price. Very, very difficult to do because it involves foretelling the future, and it's just proven to be very, very difficult. And then this was the last slide we talked about. These were the investment professionals, mutual fund managers, that over a period of 20 years actually beat this market, which was giving us the last 93 years an average of 10% in stocks. Well, 22%, 78% fail. And you have to choose those 22% in advance, which is problematic. Bonds is even worse. So that was the concluding slide last week. Now, one of the problems here, people say, well, okay, let me just get me into one of these funds. Okay, I know these are bad guys. Okay, but let's pick one of those. And then the question is, what's the likelihood that this 22% that has outperformed the market for the last 20 years will do so in the next 20 years? And there's some things that work against that probability. And here's a slide that shows what really happens. It's a little busy, but let me explain it. So you look at the funds and you say at any one point in time, you're looking back over the past 5 years and you're trying to pick good funds. So that's what I did for 35 years. And we looked at the Morningstar report and we looked at 5, 4, and 5-star funds. And those are all funds that have been doing well in the last 3 to 5 years. So the point is, I want a good fund, so I'm going to pick from the top 25%. Well, this chart shows then what happened. So I've looked back 5 years. I've looked at the top 25. It's, one of these guys, the 22%, right? And I'm saying, okay, that looks like a sure bet. And then it takes the next 5-year periods, 2005 to 2009, 11 to 15, 2015 to 2019, and asks the question, how many of these top 25 are still top 25 funds after 5 more years? And the answer is very, very discouraging. In this period, it was 23%, more than three quarters fell out of the top 25. And if you go down year by year, 2009 to 2013, only 14% of these top 25 were still in the top 25 after 5 years. And the average is 21% over all these periods. So basically, it says, if I go pick what's had a really good run in the past, even if I could do that, then I'm looking out in the future. What are my chances? And they're about 80% that I won't have a good run. And that's what I did for 35 years. I always picked good stocks. They were, or funds, they were up at the top, but next 5 years, I was always disappointed. This is an interesting chart. Many of you may have seen this at a brokerage office or something, but it illustrates why that is, why they can't perform. And the answer is that when you manage an actively managed fund, you can't select and really manage and really look into companies for the universe. There are 15, 16,000 companies that you can invest in. So any actively managed fund has to narrow that universe down to something where you get a group of companies, maybe it's 50 or 100 in a sector of the market, where you can really dive in and look at all those companies and decide which ones to buy, which ones to sell, and when to do that, and do all that analysis that the actively managed funds do. So they've got to choose something. This chart takes 9 cuts of the market, and you could have a lot of different ways to cut the market. And then it looks at, which ones for any years, 2005, 2006, what sector of the market did the best at the top, what sector of the market did the worst at the bottom, and what was their rate of return for that year. And if you look at this chart and ask, well, what's the pattern here? Do you see a pattern? And of course, the answer is you can't. it just looks random. I mean, the colors are all over at various times. So let's just for fun follow one of these. And I just, for purposes of illustration, I picked value. That's the dark green. So I'm a value stock manager. What does that mean? Value stocks are the ones that are out of favor. People don't really like them. And so their selling price, what you can buy it for, the stock price, is less than book value. Now, book value is you take the books of the company, the accounting corrections, and say, okay, here are the assets. What if I sold all the assets, paid off all the liabilities? What would I have left? My book value is X million dollars. All right. Divide that by the number of shares outstanding. If I had to give people back their money, what are the dollars per share that would represent? So I take my total net worth of the company divided by shares. That's the book value per share. So let's say the book value per share is $100. You go into the value stocks, those stocks are going to be selling for less than 100, less than what the books of the company say they should. So book value says it's 100. I'm going to look at the market value, might be 50 or 75. There are companies that are in trouble. Nobody really wants to own them. They don't look like good companies. They're not. So the joke is there are two kinds of companies. There are companies that are having trouble like these guys, and they're identifying why, and they're doing something about it. And then the other type of company is that they're doing great. They will have trouble in the future. They just don't know where and when it's going to happen. So these are out of favor companies. Well, in 2012, we were coming off a good run here, and people were seeking value, and value was very good in 2012, way up at the top, 2013, 2014. So if you're looking at past performance of these funds, you would say, well, gosh, value funds really are great performers. And so by the time 2014 rolls around, people are saying, wow, that they made 16, 43, and 17% rate of return 3 consecutive years. Let's buy value. And that's what people do. And then, of course, in 2015, it's the bottom of the heap, actually losing money. Now it comes back, it goes down. It's just so that the companies that look very good here, they're probably up here somewhere and then down. And you can see that repeat time and time again with various, here's defensive stocks. Well, okay, they look pretty good. Next year, they're way down here. So that's the problem the fund managers have, because they can be high flying for a while, but the sector they've selected go down. People buy high because they look good, because they look, these top 25, give me one of those, and then I buy it 2014 and lose money. So that's the problem. This is again one of my favorite slides, because when you go through all the math that we went through last week, you talk about all the mathematics involved in where the market goes and so forth. And I can look at the numbers and say, it's obvious everybody just ought to invest in equities and forget about bonds and CDs and cash and all that sort of thing. And my friends, the CFPs I used to work with, I still do, but they say, well, you're right mathematically, but the problem is that emotions trump math every time. And so the rest of this presentation this week is going to center on the emotional part of this whole thing, because it will trump math, and you've got to figure out how to tame the emotions, or you'll be one of those people that get half what you should from the market. This is a little busy, but let me explain it to you. It's not that difficult to understand. On the left-hand axis, we have funds flowing into equities. And these are big numbers, and they're by quarter. So this is 20, 40, 60, 80 billion dollars flowing in every quarter. That's what these bars are, to the stock market. So when you see a bar above zero, you'll see funds flowing into the stock market. Now there are periods like 2002, early 2003, where the net flow of funds is actually out of the market. People are running for the hills. Okay, get me out of the stock market before I lose my shirt, right? So That's now what you have to understand is there are whole systems that put money into the stock market every quarter just kind of automatically. The best example is 401k, 403b plan. So if you're working at a company that has a retirement plan and you sign up for it, especially if you're younger, you're probably going to land in a plan that puts a lot of money into equities, buying a lot of stocks or stock funds in your 401k. Well, what do people do in their 401k or 403b? They sign up for some program and then they forget it, which is wonderful. It's exactly what you want to do as a long-term investor, assuming you've got a good program to start with. And so those fund flows just keep coming in no matter what. So whenever you see a bar below the line where funds are actually flowing out, understand that people are selling to the extent they've overcome the money that's coming in automatically on all these plans. And so when you see these bar graphs going down, there's huge amounts of money flowing out. We're overcoming the natural flow inward, plus we're creating an outflow of funds. So that's what you need to know about these bars. And there are years where lots of money goes in, but there are years where people panic. Now it's juxtaposed against the right index, the right graph, which is the S&P 500, one of the measures of the market. And so the line is the S&P 500. So let's track this. Now, back in 1999, things were going great. And up here we have what's called the dot-com bubble. You remember that if as an investor, well, the stock market went down, bottomed out at 03. Well, what happened? People were still buying, but when they got to this point, they said, holy cow, get me out. And the huge amount of money, 20 billion net per quarter went out, plus overcoming all these inflows. Then the stock market makes this long run up to the financial crisis, and everybody says, oh my gosh, everybody's making money in the stock market, I'm going to invest. Huge amounts of money went into the stock market during this period of time. Then we had the financial crisis. That's when I retired, a very bad time. And very soon my investments went down to almost half of what they were up here. Well, what happens during this period is the most instructive. It went down and people sold all the way down. These are huge numbers. So what happened? People bought up here and they sold down here. So if you buy high and you sell low, what's going to happen to your returns? Well, they're going to be negative. Okay. So why don't people get market returns? That's the reason. Now it gets worse. Because now from 2009, this is March of 2009, it bottomed out. And for the next 4 years, 5 years, it's a nice steady uptick. But what happened? People are still selling. They're selling. They bought, they're selling. So, and then they wake up one day and say, oh my gosh, the S&P 500 or whatever index you're following is back where it was before the crash. And people have made money. They bought down here. My gosh, I've got to get back in. And all of a sudden they get back in. Well, okay. Yeah, they got out here. They sold low. Now they're buying high. And that follows all the way through here. We get a little blip here. And all of a sudden, and now again, the market from 2016, this is 2020. That's COVID. Okay. So from 2016, 2015 to just before COVID, market goes up and up and up. People are still leery of the market. They're still selling. So and then of course, the market goes down and COVID and whoop, we have this little quarterly blip where people get out again. I mean, it's crazy. So people are putting money in the market when the market's going up. They're selling when the market goes down. And the fact they're still selling as the market goes back up. And this is not a formula for success. If you just stayed in the market during these times, you didn't sell, it came back and you made money. And if you're contributing to the 401k plan or an IRA or just investments during this period of time, you're buying stocks on sale. We talked about the fact that if you own stocks pay dividends. If they get reinvested, they're buying more shares of the stock, and so you're buying again shares on sale. You ought to be happy that this happens because your reinvested dividends are purchasing stock at prices. Now today I looked in the market, S&P 500. I think is 43.25. So today, 2 years later, we're up here. Okay, so how long did that last? About 3 months. Then it came back again. I mean, it's incredible. So that if you ask why don't people get market returns, well, one of the huge reasons is they get emotional. They think when the market is going up, they need to buy in. When the market goes down, they panic and sell. And that's a formula for disaster. And that happens all the time. It happens through every period. We could draw this graph from 1929. It would show the same phenomenon, I think. So what are the reasons? Well, the stock market is always mispriced to some extent because greed, we look at good times, and greed drives the market to unsustainable heights. Stocks are making others rich. I need my share. I buy in. When there's more people buying, what happens? Well, the demand is high and stocks go to unsustainable heights. Now, fear drives the market to unrealistic lows. So the market goes down, one of these periods. So it says, I'm losing my shirt, sell to avoid losing my skin. So, I mean, it's the emotions just drive the market up and drive the market down at these kind of deals. And if you can't tame this emotion of greed and fear, then you're going to be in trouble as an investor. So here's some subtleties. We talked about one of the 4 pillars that Warren Buffett introduced us to was diversification. And I always thought of diversification as what I would now call defensive diversification. In other words, I want to diversify because one company's failure is going to be covered by other companies' success. So as I said before, through 3 mutual funds, my current investment portfolio, I own something over 10,000 companies. Well, what if one of those companies goes bankrupt, has a really bad time? I don't really care. I've got another 9,999 that are doing quite well, and I'm going to be covered. So that's defensive. But there's another concept that I discovered just a few years ago. I'm a slow learner, as I said before, and that's offensive diversification. And that is you ensure that you own the 10% of the stocks that move the market. Now, what happens each year is the market goes up on average 10%. It's an average over a long term. I mean, it could be minus 40, it could be plus 50. But what moves the market upward? When do you really get your average of 10% returns? And if you look at the data, and we will, about 10% of the companies actually move the market. In other words, 90% of your companies that you own, they're going to be doing fine. They're going to be paying dividends. They're going to be making a profit. Their stock price is going to go up. So the increase in stock price plus the dividends they pay will get you, I don't know, 4, 5, 6% pretty regularly. But there are 10% of the stocks that will do spectacularly next year. And every year it's the same. Not the same 10%, not the same stocks, but about 10% of the market, 10% of the companies out there really do well, and their stock price just goes crazy. And that's why you get 10%. So the problem is you have to own that 10% of the market, okay, or you're going to miss out. And I'll show you some data on that. So I call that offensive diversification. And the only way that you can really get the 10% is just to own practically everything. And so that's what diversification means to me. So here is how that's illustrated. If this is a period, 1994 to 2018, not a particularly good time in the stock market. So all stocks average 70. So if you owned the entire market, you would have had an average rate of return of 7.2%. If you missed those top 10% each year, you got 2.9. And if you missed the top 25, you had a negative return per year. So it's unbelievable how much you will lose if you don't have those top 10% performers each year. And again, the only way to make sure you get those is to own virtually everything. Again, 10, 12,000 stocks will probably do it. Owning the Fortune 500, it won't do it. The S&P 500 index funds have gone through decades where they underperform, something like this. So not enough diversification. Very important to be highly diversified. Now, people say, well, I can get out of the market, I can sell, I can come back in, I can sell high, I can buy low, but there are perils of doing that. And being out of the market any one day could be a real hit. The stock market is volatile day to day. I've been watching lately, and I want to get my 10% on average per year. That's per year. Well, we've had days where the market goes 1% or 2% or 3% in a day. What happens if I'm out of the market when it goes up and stays there? So big gains or big losses can happen in a day if I'm out of the market and I miss them. And this is a spectacular phenomenon. I mean, if you want to buy and sell and get in and out of the market, I mean, it is gruesome. And this is almost an unbelievable chart, but this again, the S&P 500, and it says from 1990 to 2018, that's about 28 years. No, yeah, 28 years. It says, what happens if you're in the market every day, just like a long-term investor should be? You made a compound return of 9.29. It's a little bit less than the average of 10%. If you missed one day, the best day of that 28-year period, okay, it dropped half a percentage point. If you missed 5 days, it dropped all the way down to 7.75. If you missed 25 days, you got half. Now, you ask, how many days was the market open during that period of time? And the answer is something north of 8,000 trading days. So over 8,000 trading days, you missed 25 of them, you got half the return. You missed 15, a little over half of the return you should have gotten. So if you are out of the market on these days where the thing really goes up and you mistime it, you get hit. I mean, it's out of 8,000, the 5 best days, and you drop a percentage point and a half. So 2.5%. So missing only a few days of strong returns can drastically impact your overall performance. So better to stay in, because you better be right if you get out and get back in. So taming the emotions. Stocks have returned about 10% per year on average for 93 years. Most investors get much less, including the professionals, as we've seen. And emotions trump math. You've got to tame the emotions. You've got to just do it. And that's another reason why you need a CFP or someone who's managing your money for you and counseling you and saying, okay, it's bad today. The market is down about 10 or 12%, I think, right now from the beginning of the year. What am I going to do? Answer is, my advisor is going to say, you're going to do nothing. You have this long range plan. We're going to stay in the market. You're going to get your 10% over a period of time. And so we're just going to hang in. We're not going to panic. This is, again, one of my favorite charts, just to illustrate what it takes to get those returns and how volatile the market is. So what you have here, again, is our old friend, the S&P 500, and the bar graphs show by year what the rate of return was for that 1 year period. And it's, you can see it's all over the map. Now, again, we talked about bull markets and bear markets. These above the graph, zero line are bull markets. We had 26% rate of return that year, 4, 7, 34, so on and so forth. And the average through here is going to be about 10%. Okay, so then we have bear markets that happen periodically. Here's a really bad one, That was your dot-com bubble burst. Here's your financial crisis. Okay. I remember that one a year after I retired. And then it goes through 20, and this little nice little 20 deal here is the COVID deal of 2020. So you see good years and bad years. The point of this graph, the new thing that's introduced is the red dot thing. Okay, so you see these little red dots, and what that represents is the intra-year declines. So sometime during that year, how low did the market go? And that's very interesting. So although in 1980, the year ended, if you stuck it in there, stuck it out in the stock market all year, you would have gained a 26% rate of return on your investments. But there was a time during the year when you would have been down 17%. And if you sold then, you missed out on that. And that's what people do. So if you look at these years, I mean, almost every year, you've got a significant amount, minus 34, minus 20. and here's a good year, 27% rate of return. There was a time during the year when it was a negative 19. Okay. So during that, every one of these red dots is a time for panic. Okay. So, yeah, 49. I saw that. But here's the next year, 2009, there was a point where the market was down 28%, but end of the year of a positive 23. And the average is 13.8, almost 14%. So if somebody comes out and says, oh my gosh, well, here's a bad year, we're down 14%, you yawn and say, okay, well, that's kind of an average year we're having. And if you listen to the pundits on the business news, why the sky is always falling when these points happen. So the market is very volatile. It goes up and down in the year. Just remember that in any one given year, the average decline during that year is going to be 14%. That's just the way it happens. But you could have a 28% decline and end up with a 23% positive rate of return at the end of the year. So that's the story there. So the summary, 3 out of 4 years, the stock market goes up. With bull markets, it may go down 3 years in a row. That was a tough time. It's highly unlikely the year will end with an average 10% increase. So we say, you look at 10%, you say that casually. Well, go back to this. And the question is, how many years ended in the 10% average rate of return? And if you look at them, one. So 28 years, it was only 1 year that actually had a 10% rate of return. So again, every year is different. And the average intra-year decline of the S&P 500 has been 13.8%. So you're going to get hit sometime during the year, probably. So that's all the data I had today. Next week, we're going to talk about a lot of different topics. And we're going to spend a lot of time talking to retirees, to people who are fixed income, about their investments and how much they can actually withdraw from investments and still be safe. So that'll be an interesting conversation. I have some original research that I've done that'll show some of that data. So questions, comments, thoughts, we can go back and look at any of these slides if you like.
Question. So why to even invest in bonds, CDs, and safe investments if they get erased by the inflation anyway? Why to even do that?
Very, very good question. So if you go to a CFP and say, I want to plan out the rest of my life, and I want to know how I'm going to invest all of my money, they will say, fine, we have a process for doing that. What they're going to do is ask you questions about how much money you have, and then how you intend to use it. Okay. So if you are going to need some money from your investments in the next, say, short term, let's say 3 years, I know I'm going to buy a vacation property. I'm going to buy a new car. I've got to make a substantial gift. If that is programmed for the next 3 or 4 years, they're going to advise you to set that money aside in a CD, in a money market, or whatever, and not put it in the market. Why? Because the market will go down, and it has been down for 3 or 4 years sometimes. So if you're going to have to need that money in the next 3 or 4 years, you have no business investing in the stock market. Set that money aside. Okay. Now it's not going to earn anything, but it's going to be there for you when you need to make that purchase. Beyond that, then you're a long-term investor. There's no reason why you would have any money in bonds or money markets or quote safe investments, because it's just going to be eaten up by inflation and you're going to miss out on returns. But very, very important. And that's part of the whole planning process, which I encourage you to do with the CFP. And they'll ask you, when are you going to use the money? If you're going to use it in the near term, 3 to 4 years, we need to set that aside in safe investments. We don't worry about rate of return. We just have to worry about rate on return. You just need to have a return of your money, not on your money. So that's the answer. So you're saying the money that you invest for the long term then is money you're not going to need for 3 or 4 years or more. That goes into the stock market. Very good question.
Thank you. And another question, what should you do if you see that the market is down and you're planning to retire soon or withdraw your money soon? So what's the solution? Not to retire at all, or not to take money out if you see that the market is going down? Definitely.
Well, and that's a very good question. That's the whole point of the planning process. When you go to a CFP, they're gonna plot out on spreadsheets and so forth the rest of your life, year by year by year by year. Once that plan is in place, it's going to be wrong, because things will happen to you next year, and you're going to know a lot more about the future next year than you know this year. So the whole planning process needs to be dynamic. So you put the plan together, and then something happens to you that changes the plan. The stock market goes down, and so forth. So then next year you come back and say, okay, now given that, what can I do? It may involve putting off the purchase of that vacation home or that new car, or it may involve working another year, longer than you thought you were going to work, and come back next year and see how that goes. So it's a very, very important that it be a dynamic process. When things change, it gets replugged into the model, says, okay, now how does it look? Well, it didn't look as good as it did before. Well, what can we do today now going forward to make sure that we bring it back? And so you have those kinds of options. And some of them are difficult to make. I mean, I retired, the market went to heck in a handbasket, and I asked myself, do I need to go back to work? Well, no, I delayed a move to a retirement community for another year. Yeah, so you make some of those kind of decisions, but the point is you do it in an informed manner, knowing, they say, okay, if you work another year, if you delay this purchase, we'll plug that into the model. Now, how does it look? And so you work with that until you get a solution that looks like it's workable. But life will happen, things will change. The point is, if you do that on a periodic, regular, at least an annual basis, the chances that you're going to get to where you want to get over the long term are much enhanced. They tell the illustrations, if you're driving a car for the next week to get to Los Angeles, and you wait until next Friday to figure out where you are, and you find yourself in South Texas, you're probably not going to get to LA on time. But if you check every day and you're a little off course, you can make a mid-course correction, and you'll probably get to where you're going. So that's the whole dynamic planning process. Good question.
Thank you. Any more questions, anybody?
Well, again, I'd say in wrapping up, if you do have questions afterwards, this is my email address. Feel free to email to me. You won't be put on any list. You won't be hassled. I'll try to honestly answer any questions you might have in the next week. Again, if you want a copy of these presentation materials, I'd be happy to email them back to you in a PowerPoint format.
Elena, there's a question in the chat.
We do have a question. How do you know if you have the best financial professional working for you?
Oh, wonderful question. And that sets us up tremendously for the next session next week. So that is exactly what we're going to talk about. And one of the objectives I have in making this presentation is not to make the participants CFPs or investment analysts or anything like that. But I want you to have enough knowledge of how financial markets work and how investments work so that you can go to a CFP, to an investment advisor, and ask the right questions and know if you're getting the right answers from them. And so we'll talk extensively about that next week. But I want you to be informed. I want you to be able to ask the right questions, get answers that you can understand, and then you'll be able to evaluate the advice you're getting. And most people, again, you get caught in this prison of two ideas. I either have to be an expert or I have to trust somebody. And there's a middle ground. You can trust but verify. And I want you to be able to verify. So we'll talk about that a lot next week. If you, again, first question, we can jump ahead. First question is your advisor advising you as Warren Buffett is advising? And that's the four principles, it's diversified, low cost mutual funds, stock funds. And again, as I talk to my friends who have financial advisors, the vast majority of them are not following Warren Buffett's advice. Their investments are very different. Most of them are actively managed funds. I don't believe in those. You want low cost index funds. So they're not following that advice. And so my question is, okay, is your financial advisor smarter than Warren Buffett? Good question. Are you smarter than Warren Buffett? And maybe you are. I doubt it. I doubt if your investment advisor is smarter than Warren. So that's the first test. And there are others that we'll get into next week. So come back next week.
Thank you very much, Mr. Hartzler, for your presentation. And thank you, everybody, for participation in today's program. And we will see you next week on Monday, the 21st of March. And have a great week, everybody. Thank you. Bye-bye.